What is going on, y'all? This is Pay Me in Dividends, and today is February 16th, 2025. Now, today, I got a good one for y'all. It's a little different than usual, but what we're going to do is we're going to break down the old way of investing for retirement, and we're going to talk about some of the newer strategies for retirement, and specifically we're going to talk about the FIRE movement, which is financial independence, retire early. It's basically a movement that was started a while back where people pretty much save and invest their way to early retirement. Typically, these are people who are cutting expenses, living well below their means, and doing this for an extended period of time so that they can retire in their 30s or 40s or 50s, pretty much before the traditional retirement age, which is in your 60s, at least, in the US, and I'd imagine in most other countries. But here's the reality, right? It's 2025. Most people are going to work until they die. Let's just get that out the way. Unless you plan on living on a shoestring budget in your retirement off of Social Security or something like that. But the average American, I'm talking for really the average American, or maybe British or Australian, Western countries. But the average person is going to work until they die. Let's just get that out the way. Or they're going to be working for a very long time into old age. And even once they do decide to retire, they're not really going to live the life that they want to live. That's just the reality of it, right? So let's look at the numbers. So the first thing I want to take a look at is the original way of thinking is accumulating enough money in your stock portfolio, right? Liquid assets. We're talking about liquid assets. We're not talking about home equity or things like that. We're just talking about liquid assets. So 401k, Roth IRA, taxable brokerage accounts, pension plans, whatever the case is, whatever the equivalent is in your country. We're just talking about liquid assets. The original way of thinking is accumulating enough in your total portfolio of liquid assets in order to withdraw 4% a year, basically selling 4% of your shares a year in order to pay for your annual expenses. So first, before we get to this hypothetical, where does this 4% come from? Well, we're going to look at the Trinity study. The Trinity study is an informal name used to refer to an influential 1998 paper by 3 professors of finance at Trinity University. And pretty much what the Trinity study talks about is accumulating a big enough portfolio to where you can withdraw 4% of your from your portfolio by selling shares, and then living off of that money on an annual basis. And at that 4% annual withdrawal rate, in theory, your money should never run out, because if we look at the S&P 500, on average, since the inception of the S&P 500 in 1926, on average, it's returned about 9.8%, but only 6% after inflation. So in theory, you should be able to pull out 4% or sell 4% of your portfolio every single year in order to cover your expenses. But here's the issue with that, right? First thing I want to look at is we have to look at the real numbers, right? So, and we also have to think about how humans react during times of crisis. So let's look just a couple years ago, back in 2022, the market, the S&P 500 ended at negative 19%. In 2018, it ended at negative 6%, right? If we go to 2008, during the financial crisis, the S&P finished at negative 38%. Now, granted, most of the time the S&P is profitable. That is why it has an average, long-term average return of 8 to 10%. But let's be real here, right? What if you're in retirement and there's a year where your portfolio is down 19% or 38% or negative percent? Are you really going to sit here and tell me that the average human being is going to look at their portfolio and feel comfortable selling 4% worth of their total portfolio in order to cover expenses when it is down 20% already? Do you think the average person is really going to have peace of mind being able to sell 4% of their portfolio when they are already down 20%? That ain't gonna work. It's just not gonna work for the average person. It's just not gonna work. Now let's get back to the numbers, right? So let's look at a hypothetical. Let's assume that you need $50,000 a year in retirement to cover your expenses. And again, $50K a year in retirement, that is not a luxurious retirement. That is a very, very average retirement, and you are really living within your means, especially 2025 and beyond, where the prices of things are just going to continue to go up. That's just the natural progression of any economy ever, is over time, regardless of leadership, regardless of what's going on in the world. The natural progression is that the prices of goods and services go up. So let's assume you need $50K a year just to cover your bare minimum expenses. That would mean that you would need 1.25 million in total assets, and this isn't including, home equity or anything like that. This is just liquid assets between stocks, retirement accounts, things like that. You would need 1.25 million in total. You would need a portfolio that is worth $1,250,000 in order to sell 4% of your portfolio to receive that $50,000 a year, right? So let's break it down. So let's look at the numbers, right? So you have a $1.25 million portfolio, right? Every year you withdraw 4%, which is $50,000, right? So in order to withdraw 4% from your portfolio to get that $50,000, you would need a $1.25 million portfolio. Now, let's be real, right? Look around you. Look at people who are older than you. Look at people who may be your same age. The average person doesn't have $1.25 million. That's just not the reality that we live in, right? So let's look at the numbers. So according to this article, this is from Investopedia. Let's look at the 65 to 74 bracket, or let's do 55 to 64, right? The average retirement account balance is $537,000, but the median gives a much more realistic depiction of what people actually have. And again, this does not include home equity. This is just stocks, retirement accounts, liquid assets. So this is a much more realistic depiction of people who are age 55 to 64. The average tends to be skewed a bit higher because it is averaging everybody in this age bracket, including millionaires and billionaires. But if we look at the median, which really kind of splits it down the middle for the average person, this is a much more realistic depiction. Now, 185,000 is a far cry from $1.25 million, right? The average person just does not have that type of money. There's a list of reasons as to why not. Things are expensive. I think the number one reason is people don't prioritize savings and investments at a young age, and they wait until they're older, and then it finally hits them, and then they're scrambling around to try to retire. But I digress. There's other reasons as well, but the bottom line is most people just don't have that type of money saved or invested once they get to retirement age, right? And so that is just the reality, right? So now, that is the old way of thinking, right? Now, what's the alternative? Well, the alternative is using dividend stocks or ETFs in order to generate cash flow without having to sell any shares, right? So it is 2025. The market is a lot different these days. Back in the day, in order to invest into stocks, it was very difficult. We didn't have smartphones, right? The market was not as accessible to retail investors like you and I. And even when you did figure out how to invest, there were fees, right? You had to actually call in to a broker, right? Just think about Wolf of Wall Street. If you guys ever seen Wolf of Wall Street, you know, they have these trading floors where people would call in and actually execute, and the broker would execute a trade for you, and you would pay a fee, right? Some people would pay, you know, $50 a pop just to buy a few shares of something, right? I came across this article by somebody where they said, you know, back in 1992, a broker could charge 2.5% commission just for one stock trade. You know, 2.5% just for one stock trade. So, you know, back in the day, investing for people like you and I was not as accessible. And when you did get an opportunity to invest, it was very expensive. You had to call in, or you had to walk there, or you know, go into a you know, investment bank, you know, physically to execute these trades and whatnot. But now we live in a different world, right? We live in a different world where we can log into our smartphone, we can log into our brokerage account, and we can execute these trades on our own without having to pay these huge fees, right? So again, as we know, the S&P has been around since 1926. Now, we're going to talk about the alternatives, right? We're going to talk about option ETFs and things like that. So the first thing I want to look at is, when was the options market created? Again, I want to get a little deeper into this just so you guys have an understanding as to what's going on in the market and how the stock market has evolved, right? I'm not trying to sell you guys on this idea. This is just something that I really find fascinating and interesting, and I just want to share the information with you, and maybe it'll give you kind of a different perspective on how to invest going into the future. But let's look at the options market, right? So the options market basically was founded in 1973. Now, during this time, it was the same thing as Wolf of Wall Street, right? I mean, you had to call in to these brokers, and they had to execute the trades for you, right? They had to execute the trades for you, and they would charge you money. They would charge, you know, they would make a commission off of these trades. But now you can actually do options yourself, right? You can actually buy shares of a company or whatnot, and you can execute options yourself. Now, let's talk about the issue with that, right? So for the average person, so if you know anything about options, you know that for options, in order to perform an options contract, each contract is worth 100 shares, right? So let's just take NVIDIA, for example. NVIDIA is $138 a share times 100, right? That would be one contract. You would need $13,000, almost $14,000 today, just to perform one contract on NVIDIA. Just one contract, and you'll make some premium. Let's say you buy 100 shares of NVIDIA, you sell a covered call, which is basically you're betting that a stock will not reach a certain price within a certain time window, and in the meantime, you will collect a premium, right? There's somebody on the other side of the contract who is paying a premium, and you will collect that premium. However, again, to execute one contract, you need 100 shares. So realistically, most people don't have enough money to generate a substantial amount of money in options if they're doing it themselves. So what's the alternative, right? So you have things like MVDY. But let's back up for a second, right? Let's back up for a second and let's take a look at this article, right? So covered call strategies were once the exclusive province of sophisticated options traders. However, ETFs, right, exchange traded funds, give investors basically the opportunity to buy an ETF that performs options for you, right? So a covered call ETF can boost investor income by writing call options on the stocks held by an ETF. Now, let me give you an example, right? We're going to use my portfolio as an example. I have a few, ETFs in here that are income ETFs, right? They produce cash flow and they pay me on a monthly or a weekly basis. So to give you guys an example, I'm going to use this one, right? This is AIPI. Some of you guys may know about this ETF, some of you may not. But this is basically an AI ETF, right? It pays a 34% dividend yield, annual dividend yield, and it is paid out on a monthly basis. And basically the strategy that this company employs, right, Rex, they employ this strategy. They own AI stocks and then they write covered calls. Now, again, remember the example I gave you about NVIDIA, right? Let's just use NVIDIA as an example because it's a pretty popular stock these days. If you wanted to write a covered call on NVIDIA as an individual, right, like you and I, you would need at least 100 shares just to write one covered call, which would cost $13,000. Now, what this company does is, first of all, let's look at their funds, right? Their assets under management. This ETF alone has almost $300 million in it, right? So you have these big institutions who have a bunch of money that they're throwing around in these ETFs, and they are basically executing options on your behalf, and then they wrap up these options into an ETF, and you're able to purchase shares of this ETF, and all of the money that is generated based off of their assets under management, right? They're performing these options, they're extracting premium from the options market, and then they're paying you out this annual yield on a monthly basis, right? And so what AIPI does is let's take a look at their holdings. So we can see here, we'll look at the top holdings here. We can see they have all big names, right? Palantir, CrowdStrike, ARM, NVIDIA, Supermicro Computer, Meta, Facebook, Intel, Qualcomm, right? All of these big companies. And look how much money they have in these companies. Just in Palantir alone, $41 million, right? NVIDIA, the stock we just spoke about, $26 million, right? Look at the amount of shares that they have, right? Just in NVIDIA, they have almost 200,000 shares, right? 198,000 shares. So they are able to perform a crazy amount of options on a weekly and monthly basis, and collect all of that premium and then pay you out as a shareholder. So I don't want you guys to get too hung up on this one particular ETF. This is not a video about AIPI, but I just want to give you guys examples of how much the market has evolved, right? The market has really, really, really evolved. There was a point in time where, before smartphones, you had to call in to an investment banker, and you had to hope that they knew what they were doing, and then you also had to pay them a fee on top of every trade. Whereas of now, you can just get on your cell phone and buy these stocks yourself. And not only can you buy the stocks yourself, but you don't even have to do your own options trading anymore. Now, if you like to do options and it's something that you want to do along with this, that's fine. But for somebody like me, who I really have no desire to be an options trader, if I'm just being honest with you, I really, really like the idea of just being able to buy these companies, right? Buy these ETFs from these, fund managers like YieldMax, Rex, Round Hill ETFs, Curve ETFs. And these ETF managers have millions and even billions of dollars of assets under management, where they're just performing a bunch of options all the time and just collecting tons of premium. And then they're paying you out that premium in the form of a dividend. Even big institutions like JP Morgan had the same type of strategies now, right? JP Morgan, NASDAQ income ETF. This is another one where, they pay almost a 10% dividend, 9.3% dividend, and they pay this thing out every single month, right? So you have a lot of these big institutions. You even have, Goldman Sachs has a couple income ETFs that compete with the JP Morgans, and all of these institutions now are getting in on this because it's just the natural progression of the stock market and how it has evolved. And so I don't want to get too caught up on these individual funds. And again, I'm not here to sell you anything. I'm just really interested in this, and it's really fascinating. And this is what's really kept me in the game personally as far as investing goes. It's just the idea that I can actually retire early, way before the traditional retirement age, and I don't necessarily have to have the $1.25 million portfolio, just to sell shares every year at a 4% withdrawal rate and hope that the market doesn't have an extended bear market where I'm just continuously selling shares every year and my portfolio is getting hammered, right? You can actually build a portfolio that is, maybe a fraction of this. Let's say, I don't know, $200,000, $300,000, $400,000, $500,000. Maybe anywhere from $300,000 to $500,000 portfolio, which is a lot more realistic than 1.25 million. And if you're well diversified between a few, different ETFs with big company names like NVIDIA, or even an option income ETF like XDTE, which is based off of the S&P 500 index, right? And if you just build a portfolio that has some diversification in it, and it is, cash flowing, it is paying you dividends every month, every week, every quarter, you technically never have to sell any shares, right? And so I think that's just something that's really cool. That's an idea that's really cool. And something else I like about dividend income is it is taxable income, right? Assuming that you are going to use this money before 59 and a half, which is when, technically you can pull money out of your 401k or retirement accounts, after the age of 59 and a half, penalty and tax free. Before 59 and a half, in most cases, there are exceptions like first-time home buyers and things like that. But just generally speaking, you would get penalized and taxed pulling money out of your retirement accounts before the age of 59 and a half. So assuming that this money is in a taxable brokerage account, if your goal is to retire early, right? Because this dividend income is taxable, it can be used to secure a mortgage, right? A mortgage loan. It could be used as proof of income, to sign an apartment lease, or even for the people who like to travel or any expats, right? People who have expatriated from their country and are deciding to live overseas. You can even use dividend income as proof of income for residency. And, if you guys are unsure about this, you can even look this up. I've read many, different articles and testimonies and things about people using their dividend income to secure home mortgages, to secure, car loans, and even proof of income for foreign residency permits. I came across one article. You guys can look it up if you're interested. But it just kind of caught my attention. But Portugal offers a residency permit And dividend income from your home country is one of the ways that you can prove that you have income, right? So you don't necessarily have to have a business, or you don't necessarily have to be old enough to where you're getting Social Security. But if you built your own, stock portfolio, dividend portfolio, you can actually show brokerage statements of your dividends, that you receive on a monthly basis, and use that to secure a residency permit. And again, that's just one country I came across, but there's plenty of different ways that you can use dividend income as proof of income, which again just gives you that flexibility, right? So I just think this is something that's fascinating. This has really motivated me to stay invested. The idea that I can build my own salary essentially and not have to depend on an employer for the rest of my life or into old age. So now one thing I do want to note is I work a regular job, right? But if you are in a position where you are already living off dividends, or you plan on doing it anytime soon, I would just suggest, this is not advice, but I would just suggest that you have a surplus of dividend income so that you can continue reinvesting a portion of that income, of those dividends, back into your portfolio, so that you can continue to grow your income even in retirement as well, right? So you want to have a surplus so that you can put some money to the side every month for taxes. You also want to have a surplus so that you can reinvest dividends, because a lot of these option ETFs will fluctuate as far as the distribution amount on a monthly basis, because the dividend is based off of how much option premium that these fund managers are able to extract during any given month. So naturally the payments are going to fluctuate. If you look at the JP Morgan option income ETF JEPQ, you can see that the payments fluctuate every month, right? 45 cents per share, 50 cents per share, 42 cents a share. You can see that it fluctuates. Now they do pay every month consistently, but the actual distribution per share will fluctuate. So that is just something to keep in mind, is if you do plan on living off of this. Again, this is just my opinion. I think it would be pretty smart to have a surplus. Let's say you need $5,000 a month, in order to cover your expenses or your lifestyle. I would say double it and make it 10 grand a month, just so that you can have that. You can put maybe 2 grand to the side, 20% to the side for taxes, and still have 3 grand left over after expenses to reinvest, so that, if any fluctuations happen in the market, at least you're still purchasing more shares of cash flowing, assets. So that's just something to keep in mind. But again, the overall point of this video is just kind of going over the old way of thinking when it comes to retirement. And a lot of people are waiting until old age, for Social Security, or some people think that, it's impossible to retire, right? When you look at this number, the average person doesn't think that they're going to be able to accumulate this. And the numbers show that that is correct, right? But there is a new method, right? The internet has really, really changed a lot of things. The stock market has evolved tremendously. If you just look at these tech companies and the growth of these tech companies, I mean, you never used to see this, right? Let's look at Nvidia. I mean, over the past 5 years, it is up 1,800%. That is insane. And that's not the only company. There's a bunch of different companies that, have performed like this. So we're just in a different age, where a lot of these big institutions are able to really generate tons of money in the market. There's so many ways to make money in the market. And, the fact that you can buy an ETF that is just, basically just performing options based off of these big companies, right? Or these indexes is just crazy. The game has completely changed. And so you can pretty much just accumulate shares of different, ETFs and just get paid out dividends every single month, right? So you guys let me know in the comments. I'm going to cut this one out now. I'm going to cut this video short now. I think I've rambled long enough, but you guys let me know in the comments. What do you think? What do you think about the old kind of traditional way of thinking when it comes to retirement? And then what are your thoughts on, dividend investing in general? And do you guys have any plans of, retiring early off of dividends, maybe using your dividends to travel, the world, or maybe find a different country to settle in? Are you going to use your dividend income to supplement your current income? You guys let me know in the comments. What do you plan on doing with your dividends? And are you in favor of this strategy of investing or not? You guys let me know in the comments. As always, I'm super, super grateful. I woke up really grateful this morning. I don't know what it was. Maybe because it's Sunday, but I woke up feeling very, very blessed this morning. And I just hope everybody out there is doing well. So as always, I appreciate you guys stopping by the channel, and I will catch you in the next video.